The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at the market trade after Wednesday, it was a sharply higher day in the corn, soybean, bean meal, and all three wheat classes, while bean oil under heavy pressure amid the EPA announcement on blending targets under the RFS. There's a lot to unpack here between that news and the weather. We're to try to make sense of it today. Here to help us out, Mike Zuzolo with Global Commodity Analytics is our guest analyst today. Mike, always great to catch up with you. And man, oh man, we picked a good day to talk, you and me, with all of this news in the market in front of us here today.
Yeah, as I said to somebody else, we need to get the 5-point harness that the NASCAR guys have so that we could attach that to our chairs for this next 20 to 30 days, I think, Jesse, because it's sure feeling more and more and more like a 2012 type market, both from a standpoint of the producer and what he's telling me and she's telling me, and also from a standpoint of what the price action's doing. We had a lighter volume day, than I would have liked to have seen. But we saw once again the wheat market take the lead, and I'm just here to tell you the numbers. I mean, you and I have talked long enough. I'm a big believer, analysis research-wise, that wheat should lead this market. In the last 7 trading sessions, wheat's up 18% in the soft red, probably the weakest fundamental market out there when it comes to the supply-demand fundamentals, and also the fact that we're in the middle of harvest now with unbelievable yields coming out of Kentucky and Southern Ohio, and better than expected in Kansas for the hard red wheat yields for some guys and gals. But, we got soft red wheat up about 18%, soybean follows up 12%, corn up 10% last 7 trading sessions. So that speaks a lot to me that we've got the European markets underneath us. We've got the funds underneath us as well.
Well, Mike, let's talk weather first. I think that's the the number one storyline in front of us here. And I will pull up on our video feed the new model run you shared with me. And, this lack of rainfall seemingly catching up with us. I will say I was a little surprised at Wednesday's action, just because I thought maybe we had it already factored in that we were going to get lower crop ratings. But I was proven wrong, and there's just that bullseye right in the central part of the Corn Belt that is really hurting right now.
Yeah, I don't think you're wrong, Jesse. I think what I am doing, and it may help, is go to a weekly basis in terms of the weekly closes. And I think at the 625 level, we hit on the Dees corn, and the 1375 level, we hit on the November beans. We're now probably in the mindset of trading below a 1.9 billion bushel corn ending stocks number, below a 300 million bushel bean ending stocks number. And we're probably trying to price in maybe a little bit below those carryover levels and start to take the yields down even more now that we're in midweek on this, late holiday shortened week that we're in right now. But I think you're right. I think we really want to check ourselves against the glass, so to speak, about where we closed on Wednesday versus where we closed on Thursday, because the ridge is setting up in the GFS model right over Illinois and Missouri. Ring of fire showers is what you can clearly see on this model. The European model, though, from 6, 7, 8 hours ago, was not showing that. It was showing more of the ridge being closer over Iowa and pushing the rains well into Canada and mostly over North Dakota and well into Montana. Now, the latest European model run that just came out as we go on the air here is gelling with the GFS model more that we're looking at right here, right now. And in fact, that model, the European model, actually allows a little bit more rain into Missouri. So I think you're right on the money when it comes to how we close today versus the weather. And that's why I brought up the wheat. That's why I brought up the new 30-day low in the dollar. That's why I brought up the turn to the higher levels in the crude oil market. We've got macro tailwinds also feeding this, I think.
Yeah, we definitely do. And just another graphic you sent over, just looking at that root zone, that soil moisture and the drought indicator, just another indicator of how things are going in much of the Corn Belt, and it's really a rough go. And I think about corn as well. Corn in drought, Mike, and I look at Illinois specifically. I mean, big drops in the crop ratings there this week. Iowa, big drops there as well. All of this just to continue on this weather path a little bit here. If we don't get some meaningful rainfall soon, I think we're going to see some of those estimates that you mentioned maybe even come down a little bit more here, Mike.
Yeah, this is part of those last two maps are part of a webinar I'm doing for the clients and cash and brokerage clients only this upcoming weekend. And what I'm really drilling down to at the end of these slides is, okay, I've been asked how close are we to 2012 in terms of yield projections. And keep in mind, 2012 was 123.1 on corn yield and 40 bushels on bean yield. So a lot easier to see a 40 bushel bean yield than it is a 123.1 corn yield. And so what I did was looked at this root zone soil moisture indicator, matches very nicely with what producers are telling me, and says to me that yes, if we don't get better rains in the western and northern corn belt, along with Illinois, we could see Iowa, Minnesota, the Dakotas, eastern Nebraska, and part of Kansas all lose even more yield as we go forward. So then I kind of merged that together with that drought map, the percentage of corn acreage affected by drought, which this is a phenomenal graph because it goes all the way back to 2000. And what I honed in on was 2012. And we have a current D1 plus drought in the corn of 57%. Last year at this time, it was at 17%. That's why I think we're well below 2 billion, or going below 2 billion on the corn and below 300 million on the beans because of that drought in the corn. But in mid-July, we peaked at 85% in that 2012 crop year. That's really what we're in this situation right now for the kind of the sitting in the seat of wondering if we're going to be blasting off with the 2012 type market mindset. And what I mean by that specifically, Jesse, is between June 22nd of 2012 and July 20th of 2012, just a 1 month period, November beans went from 1375 to 1686 high. And look how close we are in November beans to that 1375 right now, hitting that 1325 plus level. So I'm saying we're on the edge of 2012, and producers are telling me we're on the edge of 2012. And that means that we could be really starting to unwind the short positions even more. And I'm not trying to get bullish here. I'm just trying to say we could be cutting yields substantially. But if those models break down and that ridge breaks down and we all of a sudden get rains, then we may have be putting in our highs right now. That's called risk management. That's called profit per acre. That's called get your business done and get your puts in place before the weather models can do that to you, as far as take this market completely away from you.
And that point you just made, I think, is so key, because if you balance the weather against the ugly demand picture, this rally is great for the producer to manage that risk, because as we know, even if we pull the top off of this crop, our demand is still ugly. These prices most likely are not going to hang around for too terribly long once the rains hopefully, presumably, start to fall, Mike.
No, and let's look at it from a standpoint. We always talk about the funds and how strong they are, how powerful they are. They are, but they're out of position a lot too. I mean, look what they did in the feeder cattle. They ran those feeder cattle up to the second highest net long position since 2011. Now they're flushing the toilet on the feeders. They did the exact opposite on the hogs. They had to get out of that position. They did the exact same thing in the soft red wheat. And what I'm saying to you is there is a gap at 533 in the December electronic corn chart. We can't forget that. There's also a gap at 673 area too on the upside from way back about a year ago today or this month. So, I mean, I think that's where I really want to stay in focus with the idea that the funds, and you brought up the meal and the bean oil. What a train wreck the bean oil was today with limit down move because the EPA coming out with an unknown and unquantifiable change in their biofuel numbers. The funds got caught there as well, and they were long oil, short meal, and look what they did in this trade. They just unwound that completely. And so I'm saying let's get ahead of the funds in terms of how we do our marketing. And I hear exactly what you're saying. I couldn't agree more.
We're having a conversation here today with Mike Zuzolo of Global Commodity Analytics, and always appreciate the time and insight here, Mike. Let's talk a little more on this soy complex. I'll pull up another chart on the video feed, and I know we can rope more into this discussion about the EPA and those mandates that a lot of people disappointed in, and the impact on the bean oils you mentioned. But obviously, just looking at soybeans themselves, our prices compared to South America, our biggest competitor right now. This just ties in more into the demand discussion that we were just having. This soy market right now, there's a lot of interesting complex factors underneath of it. That's what I'm trying to get at.
Yeah, you're absolutely right. And you throw on top of that the fact that the soybeans are being helped immensely, in my opinion, by the fact that the Brazilian currency just made a fresh 1-year low, a fresh 12-month low against the US dollar this week. And that's feeding the fund mindset. And it's also making this cash chart not look as bad as it could. And what I mean by that is this cash chart between the US, Brazilian, and Argentine soybean prices, their export prices, those are all priced in US dollars in this chart, Jesse. And so we're $75 a ton higher at the US Gulf than Brazil right now. Notice how Brazil's flattened out. That's thanks to your currency market, in my opinion. And so it could be a lot worse. We could have the Brazilian soybean price closer to 490 or 485 instead of 500 as the US prices go higher here. And I think this is what it goes back to. And this is where it goes back to the fundamentals and the supply and demand and what you're leading into. The EPA came out. They didn't give us what we wanted in ethanol. We knew that last week, though. We kind of smelled that out last week. You and I kind of talked about that. Didn't realize that in the biodiesel, though. Now we have the soybeans and the South American crop. We have China buying extra right now. The trade's wondering how they're going to keep buying when their hog prices are still going lower. We also have the corn production and with the harvest progress that we're starting to get ramped up on the second crop Brazilian corn. We also have the hard red wheat in the northern hemisphere being harvested. It's going to be down, but when we're looking at the kind of price rally we've seen in soft red wheat from 622 to 735 today, I'm really starting to think of the idea we might as well, if we've got bushels to sell, just let it go off the combine, and then we can come back around and buy it back in the Dees contract, or maybe buy it back in the Dees corn or the Nove beans. And that's not a hedge, that's a spec position, but maybe trade the weather and the row crops for reownership in the wheat. That's something I'm looking at right now.
Well, and on top of all this too, to go with your thoughts with just the risk management side of this and this rally, it'd be interesting to see the weekly closes here as we get to Friday and wrap up the trade and then get into a normal trading week, a full week here next week. But also the end of next week, we got the end of the month USDA reports. Man, I shudder to think what this market could look like if we continue with a weather rally into that USDA June report, Mike.
Yeah, and this is where the bean puts are such a good piece of property, in my opinion. I know they're out of the money. Excuse me. I know that you can't get a good floor price. In other words, buying a $13 November bean put for 50, 60 cents, that takes you all the way down to a $12.40, $12.50 floor. But keep in mind, we may still have a 300 million bushel carryover or a 285 or a 275. That would, in my opinion, and based upon past history, justify going all the way back down to sub $11 in November beans come harvest. And so I talked to clients and producers and subscribers a lot last week about, okay, this week is the timing week to take it up to the level that takes us on the verge of 2012. Let's get the hedges in place, and then we can always roll those puts up if we really do have a 2012 market on our hands a week from today, because we're not going to want to sell any cash bushels. And so I'm really trying to outthink and keep the discipline in this market, because 2012 did end, and it ended badly, and it was a tough fall in 2012, and it didn't make a lot of sense to a lot of producers. Let's not forget that, because I sure haven't. I was knee deep in it and trying to hedge back then when no one really wanted to hedge. But you got great producer clients, you've got a lot of savvy marketers out there. I think they get it this time around.
Mike, let's talk livestock. You mentioned this feeder market getting pummeled, and I would love to pick up your thoughts there. We got the feeder cattle daily chart on the video feed, the Nove contract. Just walk me through here. It just feels like the bottom is maybe falling out a little bit here in this feeder cattle market, especially.
Yeah, and I think this started out with the fundamentals that Oklahoma City kind of got tired. And the cash market in Oklahoma City was always my kind of canary in the coal mine for how red hot the cash feeder market was, especially as rains came into Oklahoma and parts of Texas and pastures looked better in 30, 45 days. That really brought out the ranchers to go ahead and get some calves bought and put them down on grass. I think that ended probably 2 weeks ago. Then followed the fact that we went up to those extraordinary levels and net long positions in futures and options by the managed money funds. And then we kind of stalled out in the fat cattle trade. I think those three things are really what did this in terms of this big pullback from the 250 plus level. And I think we're probably going to go back to what I would call the demand line, the long-term support level around 230 in November feeders. And so, Jesse, if I'm right about that, we could have a $20 to $30 pullback. I actually think that's very healthy and keeps the feeder cattle market in a situation where it doesn't have to kill everybody because it's all over with, that we can maybe come back around. Friday's cattle on feed report is going to be extremely important to whether that theoretical demand line holds up just around that 230 area. Specifically, the placements, the trade's thinking 101.7 on average. If it's any bigger than that, because the top end number on the Reuters polls 103.6. If we go over 101.5, 101.7, I'm fearful that maybe the feeders want to go below what I would call that demand line.
Well, Mike, I know the fats as well. I was surprised how well the fats held up on Wednesday, even with feeders pulling under. I know cash trade, still kind of watching that just to see as an indicator on that side. Not a lot of activity so far this week. And to your point, a cattle on feed report coming up as well. All got to factor in, I would think, in the fat cattle.
Yeah, marketing's average number 101.6, that's a must-have given the fact that we're at the cash price we're at. But if we do see a good marketing's number, and I think we can, because we did do a good weekly production number last week, even though it was mostly formula cattle, it looked like to me. But that still puts you at 182, 183, maybe 185 in the cash bids to buy. That's a situation where we're now getting a discount in the futures market against that theoretical cash level. So I can't hedge cattle here as the stock market and some of the economic reports still look pretty favorable. But I still am out there thinking, get a paper position in place if we can get a futures premium, and especially the back end fourth quarter time period. I'm not giving up on this fourth quarter recession probability just because, again, I think it's good risk management to play it that way. I'm worried about the feed side. I've talked about this a lot the past few weeks. I wish more people would have gotten their feed covered. That does concern me when it comes to the fat cattle marketings as we get into the fourth quarter and first quarter of 2024. So remember what Jesse and I just talked about a few minutes ago. If we miss these rains next week, corn producers back east are telling us it's not going to be there. So it may not be too late to get some feed needs caught up on next week at this time.
Mike, hogs, real quick. I know a little bit lower on Wednesday, but really been driven by that cash market here. And I wonder, hogs, maybe we're finding a little bit of a sideways range possibly.
Driven by the cash, driven by the bacon, the belly cutout, and a little premature on the bacon and the belly cutout going higher. Driven by the funds, as I said, Jesse. I got a gap in the October hogs, I'd like that to get filled. So I'm probably going to do some light hedging here at the end of the week or first of next week, assuming that gap gets filled. But right now, I think we're in pretty good shape with the hogs, as long as China's pork market doesn't go get obliterated and we keep those weekly export sales humming.
Mike, great analysis as always. Final thoughts for us here today.
Well, it's a great time to check out the trial. Go to globalcomresearch.com. Check us out. A lot of information coming out right now and a lot of different types of media, just like Jesse's video. It's always great to be with you, Jesse. Thanks for having me, sir.
Well, we appreciate the time as always. Thank you very much. Mike Zuzolo with Global Commodity Analytics joining us here today. Find him online, globalcomresearch.com. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.